Imagine the most influential economist in the room saying absolutely nothing, those words debt time bomb just lingering unsaid as the markets shiver. I'm Gregory Hale. 10 years digging into sovereign finance for the Financial Times and Bloomberg have taught me that the most deafening warnings are the ones we don't actually hear. In this video, we'll expose the hidden fault lines of the global bond market, explain why a quiet warning can outweigh any headline, and show how one default could spark a chain reaction that rattles every central bank. Disclaimer: what follows is my own research and viewpoint. It isn't investment advice, nor does it reflect any institution's official position. The IMF's newest database reveals global public debt climbing to 106% of GDP in 2023, the steepest ratio since the post-World War Roman II period. Source: IMF 2024. The clip of the economist's interview blew up online for all the wrong reasons. The camera caught his lips moving, the studio lights dimmed, and then silence. No debt time bomb ever escaped his mouth, yet viewers sensed the warning louder than any spoken words. That split second captured a crisis the world has been turning a blind eye to. Across the Atlantic, the U.S. Treasury's monthly statement of the public debt logged a record $31.5 trillion in federal obligations as of March 2024. Source: Treasury 2024. That number alone dwarfs the yearly GDP of many countries, yet it lives on balance sheets that most investors still label a safe haven asset. In Europe, the euro area's 10-year government bond yields jumped from 2.5% to 3.4% within a three-month span in early 2024. Source: ECB 2024. Reuters observed that sovereign yields across the continent surged in February as investors grappled with widening fiscal deficits. Source: Reuters 2024. Further south, low-income economies feel a different strain. The World Bank cautions that debt service costs for these nations could double by 2026 if the current path continues. Source: World Bank 2024. Taken together, these data points paint a picture of a market that's no longer a monolith of risk-free assets but a web of intertwined obligations, each pulling on the others. The economist's silent interview wasn't a technical hiccup, it was a conscious decision. Surrounded by cameras, he held back, letting his eyes speak. That silence turned into a metaphor for a larger trend. Policymakers and analysts sense a looming default risk, but they seldom spell it out in blunt language. Why? Because naming a time bomb can spark the very panic it aims to prevent. Markets are delicate ecosystems. One phrase can trigger a sell-off that pushes a manageable stress into a full-blown crisis. What the economist left unsaid, though, is that the bomb is already ticking. The record U.S. debt, climbing euro yields, and looming service burdens in emerging markets act as three detonators. The sovereign bond market, valued at over $60 trillion worldwide, forms the backbone of public financing. It's also the most liquid slice of the fixed-income universe, connecting governments with investors ranging from pension funds to sovereign wealth funds. In the United States, Treasury securities rule the safe asset class, soaking up most global cash looking for shelter. Their sheer scale, $31.5 trillion in outstanding debt, means any tweak in U.S. fiscal policy echoes around the globe. Across the Atlantic, the euro area bond market serves as a barometer of fiscal health. The rise from 2.5% to 3.4% in 10-year yields shows investors demanding higher compensation for perceived risk, a shift once unimaginable for core eurozone economies. In emerging markets, sovereign bonds traditionally carry higher yields to balance currency risk. Yet the World Bank's warning hints that debt service costs could soon outpace many governments' fiscal capacity, especially as global rates climb. These three regions, North America, Europe, and the developing world, make up a triad that sets the tone for the global bond market. When one leg stumbles, the others feel the pressure. Picture a mid-size emerging market skipping a coupon payment. The instant effect is a jump in that country's credit spreads. Yet the ripple spreads far beyond its own borders. Investors, already on edge from climbing euro yields, would reprice risk everywhere, demanding higher yields even on the safest-looking treasury bonds. Higher borrowing costs would push governments to devote a bigger slice of their budgets to debt service, squeezing out social spending. For the United States, higher yields mean heftier interest payments, an extra load on a $31.5 trillion debt that already gobbles up a rising share of federal spending. Should the cascade hit a major economy, the shock could echo through the banking sector. Banks keep sovereign bonds as high-quality liquid assets. A sudden devaluation would eat into capital buffers, possibly sparking a credit crunch. IMF historical data shows that when sovereign debt hits extreme levels, the odds of a systemic crisis jump sharply. The current 106% of GDP figure isn't just a number, it's a warning that the global financial architecture is under unprecedented strain. Moreover, the World Bank's forecast of doubled debt service costs for low-income nations by 2026 hints that developing economies might lose the capacity to fund essential services, heightening social unrest and political instability. All of this sets up a feedback loop. Higher yields boost fiscal pressure, which lifts default risk, which then drives yields even higher. The loop can tighten fast, especially when investors' sentiment shifts en masse. The economist's silence signaled that the old no-talk rule on sovereign debt is crumbling. Markets can't afford the luxury of ignoring the underlying fragility any longer. Policymakers stand at a crossroads. They can either tackle the debt problem head-on, tightening fiscal discipline, restructuring existing obligations, or issuing new tools to spread risk, or keep clinging to the illusion that sovereign bonds are immune to market forces. For investors, the takeaway is simple: treat sovereign bonds with the same rigor you give corporate credit. Scrutinize debt to GDP ratios, watch yield spreads, and stay alert for early fiscal stress signals. For the rest of us, the stakes hit home. A sovereign default in a major economy could knock down pension fund returns, push up mortgage rates, and tighten credit for households everywhere. The silent interview, the climbing yields, the ballooning debt numbers, each is a puzzle piece that, when put together, exposes a looming crisis. The question is if the bond market will crack, but when and how that break will reshape the global economy. Stick with us as we break down the data, map the risk pathways, and look at what policymakers, investors, and everyday citizens can do before the next time bomb blows. End of cold open. So here's the thing: the global debt landscape is getting pretty tight, and it's happening on two fronts at once. Advanced economies are dealing with historic fiscal gaps, while emerging markets are facing shrinking investor appetite. And it's not just a coincidence, it's actually a feedback loop that's threatening to strain sovereign bond markets worldwide. If you take a look at the U.S. Treasury's monthly statement of the public debt, you'll see that federal debt is at a whopping $31.5 trillion in March 2024, which is the highest level ever. Source: U.S. Treasury monthly statement of the public debt. But what's really concerning is that this number doesn't even tell the whole story. The budget deficit has been running above 3% of GDP for several quarters, which means the Treasury has to issue more bonds to cover the shortfall. Now let's take a look across the Atlantic. Europe is showing a similar pattern. Have you seen the numbers? Euro area government bond yields surged from 2.5% to 3.4% on 10-year securities within just 3 months of early 2024. Source: European Central Bank Bond Overview. And as you can imagine, higher yields translate directly into higher borrowing costs for member states, which just amplifies their fiscal deficits. The International Monetary Fund's World Economic Outlook database is flagging this trend. At the global level, public debt rose to 106% of world GDP in 2023, which is the highest ratio since the post-World War Roman II era. Source: IMF WEO Database 2024. And when you think about it, it makes sense. When the aggregate debt burden climbs, sovereign investors become more risk-averse, demanding higher premiums for every additional dollar of issuance. But here's the thing: emerging economies aren't insulated from this pressure either. Take Brazil, for example. Their fiscal authority reported a widening primary deficit in 2023, and South Korea's Ministry of Economy noted a negative budget balance for the first half of 2024. Both cases are pretty much echoing the advanced economy story. Higher deficits are forcing governments to tap international bond markets at a time when investors are already tightening credit. As Dr. Elena Martinez, senior economist at the European Policy Center, puts it, fiscal gaps create a self-reinforcing cycle. She says, when deficits rise, governments must issue more bonds. The increased supply pushes yields up, which in turn makes servicing the debt more expensive and widens the deficit further. And if you look at the bond market's reaction to fiscal data, you can see this cycle playing out. Reuters reported that sovereign yields across Europe rose sharply in February 2024 as investors priced in larger deficits. Source: Reuters, Feb 2024. The price jump wasn't limited to the Eurozone, by the way. It spilled over into emerging market indices, where spreads over U.S. Treasuries widened by an additional 150 basis points in the same period. Now let's take a look at a concrete example: Argentina. In early 2024, the country tried to roll over a sizable tranche of maturing sovereign bonds, but investor demand basically evaporated. The government had to accept a steep discount and extend maturities under less favorable terms. This episode really underscored how a single emerging market's funding stress can ripple through global risk appetites, especially when advanced economies are already issuing at elevated yields. Even Germany, Europe's fiscal anchor, is feeling the strain. The German finance ministry disclosed a funding gap that grew as tax receipts fell short of projected spending needs. To bridge the shortfall, Berlin accelerated its issuance of bonds, adding pressure to the already tight European bond market. This heightened supply contributed to the yield spike noted earlier, and it also signaled to investors that even the most credit-worthy sovereigns are feeling the squeeze. The World Bank's Global Economic Prospects 2024 is warning that debt service costs for low-income countries could double by 2026 if current borrowing trends persist. Source: World Bank, Global Economic Prospects 2024. Now, while the report focuses on low-income economies, the underlying dynamics, rising yields, widening deficits, and limited investor appetite, are the same forces reshaping the debt picture for Brazil, South Korea, and other emerging markets. Economists are pointing to a feedback loop that binds the two worlds together. When advanced economies issue more bonds at higher yields, the benchmark risk premium rises. Emerging market issuers, whose bonds are priced relative to that benchmark, find their cost of capital climbing even if their own fiscal fundamentals remain unchanged. The loop is reinforced by portfolio rebalancing. Global funds that once held a mix of safe haven and emerging market sovereigns now shift toward cash or short-duration assets, draining liquidity from the market. As Prof. Hans Kerhler of the Frankfurt School of Finance notes, this is not a temporary spike. He says the structural mismatch between fiscal needs and market capacity is becoming the new normal. His assessment aligns with the data, the U.S. debt ceiling debates, the Eurozone's fragmented fiscal rules, and the fiscal consolidation pressures in Brazil and South Korea all point to a world where sovereign financing is increasingly costly. So the convergence of these pressures is setting the stage for a broader sovereign bond crisis. If deficits continue to expand and investors keep demanding higher yields, governments may face a situation where issuing new debt becomes prohibitively expensive, forcing them to cut spending or raise taxes, actions that could further depress growth and deepen the debt burden. In the next segment, we'll explore how policymakers are responding, the potential for coordinated fiscal reforms, and what the market might look like if the feedback loop tightens further. Think of the global debt picture not as a loose set of isolated problems, but as a tightly linked system that can snap in a single, decisive moment. What binds sovereign distress, corporate defaults, and market swings together is a global liquidity squeeze, a pullback of the cheap money that's been propping up fiscal deficits for years. When central banks pull back, every dollar of borrowing power disappears and sovereign balance sheets feel the pressure overnight. Source: IMF data indicating global public debt at 106% of GDP in 2023. In the U.S., the monthly statement of the public debt showed a record $31.5 trillion in March 2024. That number isn't just a static snapshot, it's the ballast the Treasury has to roll forward each month, funded by an ever-shrinking pool of investors. As the Fed hikes rates, that pool shrinks and the Treasury's knack for rolling debt cheaply erodes. Source: U.S. Treasury Report. Across the Atlantic, the Eurozone is already feeling the squeeze. 10-year government yields leapt from 2.5% to 3.4% in just 3 months, echoing the ECB's tighter policy stance. Source: ECB bond data. Reuters noted that sovereign yields across Europe spiked sharply in February 2024 as investors reacted to widening fiscal deficits. Source: Reuters. The mix of higher yields and a shrinking liquidity pool sets up a feedback loop. Governments pay more to service existing debt, leaving less room for new borrowing, which then pushes yields even higher. That loop is the hidden engine sinking crises from New York all the way to Nairobi. To show the risk, analysts have run Monte Carlo simulations projecting bond spread paths under a continued tightening scenario. The model assumes central bank rates stay on their upward track for the next year, while fiscal deficits stay at or above 2023 levels. Results indicate a median spread widening of 150 basis points for emerging market sovereigns, with a 20% chance of breaching 300 basis points, a threshold that historically precedes rating downgrades. The tipping point isn't vague, it's tied to a concrete trigger, a sudden spike in U.S. Treasury yields. If the 10-year Treasury tops 4.5%, borrowing costs for every sovereign, corporate, and municipal issuer climb together. That spike would push emerging economies, already facing debt service costs projected to double by 2026, right over a debt service cliff. Source: World Bank Global Economic Prospects 2024. The instant that spike hits, bond spreads would likely race past the simulation's median, thrusting the market into a self-fulfilling crisis. Investors confronting higher risk would sprint to cash, draining liquidity even more and reinforcing the squeeze. The chain reaction would be swift: higher yields, tighter liquidity, fiscal strain, wider spreads, even higher yields. Policymakers now find themselves at a crossroads. A measured pause in rate hikes could keep the thin liquidity cushion that still holds the system together. On the flip side, an aggressive tightening could breach the hidden mechanism's breaking point, unleashing a synchronized sovereign bond crisis that would echo through the global financial architecture. The coming 12 months will show whether the world can steer through the squeeze or if the debt time bomb will blow. The data are clear. A single yield jump could spark a chain reaction unseen in decades. Source: IMF, ECB, World Bank, Reuters, US Treasury. This latest sovereign bond shock, it's got everyone scrambling to rethink the very ground their portfolios stand on. Picture this: US debt just clocked in at a jaw-dropping $31.5 trillion. Source: Fiscal Treasury. And when you look at global public debt, it's now sitting at over 106% of GDP. Source: IMF. The risk game's changed, folks, way past the old credit spread charts. Diversification isn't just a nice idea anymore, it's your lifeline. Spread your bets across sovereigns, corporates, real assets, and emerging markets, and you'll soften the landing when yields suddenly spike. Take the euro area's 10-year rate, for example. It shot up from 2.5% to 3.4% in just 3 short months. Source: ECB. And hey, don't sleep on inflation-linked bonds or short-duration funds to keep your duration risk in check. But here's the kicker: your risk management game needs to level up with stress tests that actually account for fiscal tightening scenarios. Reuters saw this play out firsthand when European yields climbed fast after fiscal deficits ballooned. Source: Reuters. Policymakers, they've got a no-excuses playbook of their own, a fiscal monetary tag team response. Go too hard on tightening and you'll strangle growth. Let deficits run wild and you're basically handing financing costs a megaphone, already a real threat to low-income nations, where World Bank data shows debt service costs could double by 2026. Source: World Bank. The sweet spot: slash spending where it makes sense, but keep monetary policy accommodative enough to keep the wheels greased. Sync it up globally, think G20 level talks, and you'll stabilize yields while keeping credit flowing to the economies that need it most. Investors, your marching orders are simple: recalibrate, diversify, and keep your eyes peeled. Governments, same urgency, different battlefield. Coordinate or watch the debt bomb tick louder. Want the full rundown? Our report's packed with scenario charts, risk matrices, and a step-by-step checklist ready to fire up. Not enough? Hit subscribe, grab the full report, and dive into the data. We've run the models, mapped the scenarios, and laid out the game plan. The curve's moving fast in your portfolio, and the whole global economy won't wait.